Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome to Different Makes a Difference. I'm Stephen Boland. So another year is coming to an end. 2025 was Donald Trump's first year back in office, and he increased tariffs to levels not seen in decades. We got a new prime minister in Canada. There was softness in certain areas of Canadian real estate, and artificial intelligence continued to capture headlines and imaginations. Through it all, and despite a sell-off in the spring, it was a good year for the stock market. We're recording this in mid-December, and the S&P 500, which is the main stock index in the US, is up 17% for the year, or 12% in Canadian dollars, because the Canadian dollar strengthened versus the US dollar in 2025. And the Toronto Stock Index is up an impressive 30%. To have a look back at the biggest investment stories in 2025 and to contemplate 2026 and beyond, we're joined today by Odlum Brown's Chief Investment Officer, Murray Leith. Thanks for joining, Murray.
Good to see you, Steve.
So Murray, as mentioned, it's been a good year for stocks. What has driven the performance of the stock market here in Canada and in the US this year?
Well, it's been very concentrated for different reasons in both markets. In the US, it's very much the AI revolution that's driving that market. We know the Mag 7 companies that we've talked about. I think people are pretty familiar with the Apples and the Microsofts and the Amazons that are part of that grouping that has been really a driver of the market for many years, but it's broadened out. There's a lot more participation in that trade, and other sectors have done well as well. But here in Canada, it's been the gold stocks that have been the real star performance. The gold miner sub-index of the Canadian market, I believe, is up 130% for the year to date, which is really quite spectacular. But if you look at the last 2 years, the Canadian market is up total return, including dividends, about 58%. The US market is up a little more than 50%. And both those numbers are pretty remarkable. It's a tough market to keep up when you have a high level of concentration in what's driving the market. Our model portfolio of Odlum is actually doing pretty well. We're pretty much in sync with the US market in terms of having a total return of a little more than 50% over the last 2 years. Hard to keep up in Canada with those gold stocks. We're underweight the AI trade relative to the crowd, and I'm sure we'll delve into that and why we are. And here in Canada, we this cycle, we don't own any gold stocks. So we have other things that are helping, but it's tough to keep up. A lot of managers are finding it tough to keep up when you have both the Canadian and US benchmarks highly concentrated in hot areas.
Absolutely. So let's dive into that a little bit. Why are we underweight AI-related stocks?
It's very exciting. There's no doubt that AI is going to be transformational and changing the way the world operates, how we all participate in it. I don't think anybody knows exactly how, but I think we're all agreed that it's going to be transformational, and I think we can take that as a given. There's a belief that we're going to be in a major investment cycle for a number of years here, building out these data centers that crunch all the data and drive this revolution. But what gives us pause is just the valuation multiples. And think about it this way. 10 years ago, these companies that are driving or leading this charge had lots of runway, lots of potential, and their valuations were a fraction of what they are today. And yet today, with much higher valuations, prospective returns are nowhere near what they were a decade ago. And yet the crowd and the sort of the weightings in the benchmark are way bigger. The commitment to these stocks is way bigger today than it was 10 years ago. And to us, that's upside down. So we believe in it and we want to participate in it. It's very exciting, but we've sized our exposure accordingly. Maybe a third of the weighting in towards the AI trade relative to, say, the S&P 500 index in the US.
Right. Sounds like good prudence there. And I'll remind listeners that we did a podcast episode a few weeks ago entitled, Are We in an AI Bubble? So I'd encourage you to give that a listen, and we dig into AI a little bit more. Let's switch over to gold, which you mentioned is driving the Canadian market, and we're underweight gold as well. Why are we positioned that way?
We have owned gold and gold stocks before, and as I said, unfortunately not this cycle. Our in-house resource analyst, Phi Lee, actually put out a recommendation to own gold a year ago, and a number of our advisors and clients would have gold in their portfolio, but I did not put it in our model portfolio. And and as I said, we're doing okay without it, but I understand, the reasons what's driving it. There's more inflation in the world. Gold has proven to be a great inflation hedge over the long term. I'd argue that common stocks are a better inflation hedge because not only do they keep up with companies with good pricing power, not only keep up with inflation, but they add value on top of that, which is part of the reason we like companies over gold. But it's seen as a hedge against the debasement of fiat currencies, and that's something that we can pull on that thread. The world's a riskier place, and so it's a place where people go for safety. And central banks, after years of sort of selling their gold reserves, have been building them back up again, in part because of the destabilization, the geopolitics in the world. So there's a lot of good reasons around it. People understand it. I've never been a gold bug. I don't get up in the morning and think about gold. I get up in the morning thinking about, what are the good businesses that I want to own? What are the management teams that I want to invest alongside of? And that's what gets me excited. Warren Buffett always says, stick to your circle of competence. And the way I'm wired, I tend to get, to the extent that I've owned gold, I tend to get interested once it's gone up. And then I get uninterested when it goes down. That's not the way you want to be wired. You emotionally wired the opposite way. So, that's me, but I'm not other people. And other people, there are gold bugs out there. There are people that think about it when it's down and out and nobody's looking at it, and they should absolutely own it. And right now, I'm not going to jump on board. I think oil, for example, is a lot more attractive. Oil stocks are one area of the market that is very neglected. The valuations are still very good. The companies cash flow a ton. And I was just looking this morning at the ratio of gold prices to oil prices going back to the beginning of the 70s. And the ratio is at an extreme high. The only time that it was higher was during the pandemic. And that only happened because temporarily, as crazy as the world was back then, oil futures traded negative. It was because you couldn't get rid of the oil when the world locked down. So I think it's pretty extreme. Gold's done so well, it's outperformed the US stock market over the last 20 years, which is pretty remarkable. So I'm envious of all those that own it, but I'd rather own a good business today than gold, or oil stocks than gold. I just think it's better value, and it'll treat us better over the next few years.
And owning stocks has done extremely well over time as well. So that's some really good perspective on gold. Some people believe Bitcoin is a new type of gold, a digital currency that could protect value or perhaps enhance portfolios over time. I know you don't have the same view. You are not a fan of Bitcoin. Tell us why that is. And actually, let me just add that I was a little bit surprised when I looked yesterday that Bitcoin has actually been down year to date. Given all the headlines, I thought it might have had a better year than it did.
Yeah, no, it's down more than 25% from its high, which is a decent correction. And therein lies one of the, the reasons people believe in Bitcoin, and it's generally been doing well over the last number of years. The same reasons people like gold, and I understand that. But, I was watching a podcast with Steve Eisman, the Big Short fame, the other day, and he was highlighting all the reasons that people were given for why cryptocurrencies have had the big correction. And the common denominator was that none of the explanations were fundamental, because there's no fundamentals to analyze. And that's my issue, is that I can repeat the narrative that explains why it's going up when it's going up, but it's going up because more people want to buy it. and it goes down when fewer people want to buy it. And I don't want to hold hands when it's down 50% and trying to explain to people why it's down, because there isn't going to be a fundamental reason to explain why it's down. It's down because there's more sellers than buyers. And frankly, I wrote a piece recently titled Digital Tulips. One of my favorite books was written by Burton Mackall titled A Random Walk Down Wall Street. In the first part of the book, they go through all the manias over time. And every time there's a new one, they add a new chapter. And I think it's the book that I've rebought more times in my life. I used to lend it to people. I'd never get it back. And so I'd have to rebuy it for that reason. But, when Japan had their huge correction, they wrote a new chapter on that. When we had the dot-com crash, there was a new chapter on that. And I'm certain there will be a cryptocurrency chapter sometime down the road. I just don't know when.
Interesting. Yeah, I think it's a great point too on the fundamentals. We like cash flow producing businesses, and you don't get that with Bitcoin. You don't get that with gold. I want to flip over to Donald Trump. What kind of year in review would it be if we didn't comment on his first year back as president of the United States? He promised to roll out tariffs, and he did indeed roll out tariffs. In April, he announced what he called his Liberation Day, where he really ramped up tariff rates around the globe, sent the stock market into a bit of a tailspin, but the market came back quite strongly. Certainly, tariffs have still impacted some people to a great extent, but we have not seen the widespread devastation from tariffs that some people had feared. Why is that? What is the latest on tariffs, and how do they factor into your thinking around investing?
Yeah, it's remarkable in one sense that the market can rise with that level of destabilization and a shock to global trade, because these are, collectively around the world, these are the highest tariffs that we've experienced in decade. You got to go back to the Depression era, and the fact that the market's just rising on good news or bad news is surprising to a lot of people. But I think the other thing we got to remember is that traded goods have been a shrinking part of the global economy. The global economy has become more and more of a service economy. So that's part of the reason. The US, for one, is more of an insular market than a lot of countries like Canada or Germany. So that sort of lessens the bite. But let's not kid ourselves. Like, tariffs are a tax on consumers, US consumers. And despite what Trump's rhetoric is that foreigners are paying them. No, they're not. Like, they're to the extent that they're paid, I guess foreign companies will maybe relax their pricing, maybe eat some of it, but a lot of that burden falls on US consumers, and many of them are struggling, and more of them are struggling, I think, because of the tariffs. So, and that's, we may get to it, but that's one of my worries. And I've worried about inequality and social unrest for years. And Trump says he's for the people, but tariffs are not for the people.
So tariffs have indeed impacted the consumer. When I look at the stock market returns by sector in 2025, consumer-related stocks have done pretty poorly in general. Certainly a portion of the consumer base has been under pressure. You just mentioned some of the inequality. You recently wrote about the K-shaped economy. What is a K-shaped economy, and why does that matter?
Well, a K-shaped economy is something that, economists have been, that's the way they've been describing the economy, or some of them have anyways for a while. And the idea is that the economy is not treating all participants equal. And the upper echelon, the wealthy, the dominant companies are doing well, and the rest are not. And, in the US, the top 10% of income earners are driving 50% of consumption, which is it's a pretty mind-boggling statistic. And the top 10% used to drive a third of consumption in the US, and now it's half. And that's largely being driven by the wealth effect. The people with the better incomes are also the people that own more of the homes and more of the stocks and bonds and other assets. And in society, we keep inflating the value of those by printing more money and keeping interest rates relatively low. It's great if you're an investor. It's been great for our clients and for our business, but it's tougher and tougher on the rest that don't own assets, and they feel like they're falling further and further behind, which is driving social unrest and some of the crazy politics that we get.
How does that end? How does that get better?
Well, that's a great question. And I think, it's why we're getting, like a socialist mayor in New York talks about, policies that redistribute wealth. It's why we got a fairness budget from Justin Trudeau before he was pushed out of office that, was going to raise capital gains taxes. And that got reversed because Trump came along with his trade war. And that's the last thing we need to be doing, is discouraging investment in this country when that's going on. But, that's what's driving these policies. And some of them will be warranted and fair and, or perhaps the right thing to do. But some of them are going to work at odds with the overall economy, which won't be good for everybody, rich or struggling. So that's why we watch it closely.
Yeah. So you mentioned Trudeau being pushed out of office. We talked about tariffs. Well, amidst the tariff headlines back in April, we had an election here in Canada, and a new prime minister was voted in, Mark Carney. And we're now a number of months into his term, and he's pursuing several economic initiatives. He's trying to diversify our trade partners, encourage new investment in infrastructure, trying to capitalize on our resource base. How are his initiatives impacting your view of the Canadian economy, and how might that impact the stock market in Canada?
Well, that's a loaded question. And I sort of would like to come at it a few ways, but maybe I'll start with, I came to Odlum Brown in 1994, and at that time, Canada was in a debt crisis. We'd actually struggled and almost failed to issue some bonds at the time. Our finances were really out of control. Our government debt levels were very high, and we were in trouble. And the Wall Street Journal was writing articles about Mexico North and joking that our currency was the Canadian peso. And there was concern that we wouldn't be able to get out of this so-called debt trap. And institutions like the Fraser Institute were pointed out that more Canadians take more from government than pay in taxes, and therefore will never vote for change and get our fiscal affairs in order. But you know what? We did vote for change, and we brought in a liberal government that took an axe to our budget, balanced the budget. We got lucky. The world around us was growing, and we got our affairs in order much quicker than people thought. I think we're at a similar TSN turning point. And the lesson from that episode is that, when human beings are down, they don't like to stay down, and they like to do something about it. And that's what Canadians did back then. And I think thanks to President Trump and his trade war and talking about Canada as the 51st state, like, we are really rallying about the need to invest in our future. And Canadians universally, I think, were upset that the economy had not gone anywhere for the last decade in terms of productivity or per capita GDP, or, individual share of the economy had been flat for about a decade. And that was increasingly unacceptable to all Canadians. The trade war shock and Trump's rhetoric caused us to rally even more around that. So I think there's been a mind shift similar to what we experienced in the 90s, and that Canadians expect more out of all politicians, regardless of political stripe, and are demanding that. And they don't want politics. They want policies that are going to move Canada forward. The Carney government has offered that up and been given a chance to do that. I think all the parties are going to be more thoughtful, and we're going to get better government going forward. So I don't want to get political here, but that mindset shift, I think, is going to put Canada on a trajectory to be in a much better shape down the road. The tough thing is that the things that got us, to where we are, and I've talked about this in I think some of the past podcasts, is that we've really become a country of real estate speculators. We haven't had a real estate cycle in this country since the early 90s. And we've invested in real estate instead of business and R&D and innovation. And we've got to do more of the latter and less of speculating in real estate, because that doesn't make our future brighter. We and every other government around the world have gotten bigger and less efficient. Governments in Canada and everywhere have to get more efficient. And then we really blew it on the immigration front. And this is a country that was built by immigrants, and we need immigration policy to be able to pay for the entitlements that we can't afford, and the fact that the population is aging. But we let too many people in too quickly, and we weren't thoughtful about it. We weren't prepared for it from a housing perspective. It put upward pressure on housing, made it more unaffordable. It created even bigger lineups in healthcare. And so, we're correcting all these things, and we're in the midst of a real estate cycle. That means the economy is going to get tougher before it gets better. But the silver lining in that is that I think it's going to sharpen Canadians' minds in their expectations of our political leaders in terms of how we build forward. So to the extent that it gets tougher in the near term, it makes me more optimistic longer term.
Interesting. Let's just pick up on real estate. It's a big asset for a lot of people. In 2025, we saw some pockets of weakness. I know here in Vancouver, I talked to my friends in Toronto, going through the some decline in housing prices. Certainly not everywhere in Canada, but in certain big markets. What's going on? Why is real estate pulled back a bit? And where do we go from here?
Well, I think the thing you have to remember is we haven't had a meaningful real estate cycle or correction in Canada since the early 90s. That's a very long time, and an unusually long period of time without correction. And I bought my first home in 2002, so 23 years ago, and I thought I was paying top of the market. So frankly, I'm very grateful that I make a living giving advice on stocks and not real estate, because I've been expecting a correction ever since, to be honest. And we are definitely in a correction now, but how long it goes is it's not anyone's guess. Like, there are some things that the government can do, but I think it's going to go on for a while here, and mainly because homes are just very unaffordable in Canada, and particularly in the big cities of Vancouver and Toronto. Just to sort of give you some context, when my father bought our family home here in Vancouver in the early 70s, the ratio of the average home price to the income of a younger person, say 25 to 35, was about 4 or 5 times. When I bought my home 23 years ago, that relationship was 10 to 12 times. And today, it's 20 to 25 times. So it costs a lot more. A young person buying a home has to save for a lot longer to get that down payment. And then they have to take on this monster mortgage, and will be paying it off much later in life than generations before them. So it truly is tough. And, I think some of that will correct out of the system.
So a lot of good information here today. Let's put it all together and say, how should investors position their portfolios going forward?
Well, there's all this bubble talk. And so, we have people worrying about the correction or the great reset, as some people talk about. And, I think there's a number of things that I'm saying. Like, number one, stocks have done a lot better than fixed income, as they normally do over the long term. But, as I said, the North American benchmarks are up more than 50% over the last 2 years. So naturally, when you have a plan, and everybody should have a plan, and an ideal asset mix, there's rebalancing to be done out of stocks and into bonds just to get your weights back on plan. And so people are doing that. The other thing, irrespective of the odds of a correction or whatnot, which we'll talk about, we can't predict. Most of the baby boomers, which are a lot of our clients, people's home values have gone up way more than they expected. Their investment portfolio has performed way better than was needed in their financial plan. So people can afford to be more conservative. And given the worries in the world, many people are choosing to be more conservative, and that's sensible. People want to sleep better at night. Why not, if you can afford to? And so people are balancing portfolios and maybe a bit more fixed income, and interest rates certainly are higher than they were a number of years ago, when they were close to zero. So you can actually get a return, but it's more about comfort and durability when doing that. But I still believe in stocks. I own a lot of overpriced local real estate, and then the rest of my portfolio is in the stock market. And I've got a decent cash buffer that, I've carried ever since the financial crisis. It was just a lesson there that, if we'd gone down and stayed down for a long time, I wanted to have a cash buffer. Makes some sense, but I still believe that you can put together a good portfolio of quality companies at reasonable prices. And I think that's always going to do better than fixed income. And so I believe in that. I do not believe in timing the market. This year's a case in point with the craziness that we've had, and yet stocks are up a bunch. We had the pandemic. We thought that we were going to be in for a long and grueling recession. It ended up being 2 months and the shortest on record. When the central banks slammed on the brakes and raised interest rates in 2022, we and everybody else expected a recession. We're all still waiting for that recession. And if you'd gone to the sidelines waiting for the better opportunity, you've certainly missed out on a lot. And the way the stock market works is you have to be in the game to benefit from the compounding over time. And you have to just simply accept the fact that markets will go down. We don't know when they're going to go down. And you just have to have the resolve to ride it out for the long term.
That's great advice, Murray. I think that's a great place to end it. Thank you for joining us here today. If you'd like to hear more from Murray, he will be presenting at our annual address in early February. It'll be held in various locations around British Columbia, and this year he's going to Calgary as well. If you'd like to attend, please reach out to your investment advisor. If you don't have an advisor but would like to attend, reach out to our firm. Give us a call or send us an email. That information is on odlumbrown.com. And if you don't live nearby, we'll happily share a recording. I think you'll find it valuable, and it'll be great to meet some of you in person. We hope you had a good 2025. All best wishes for 2026. Take care, and we'll talk again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.